The idea that the United States economy is broken is not rooted in a sudden collapse, but in a slow, structural unraveling that has been decades in the making, masked by the illusion of growth, financial engineering, and global dominance that once defined the American empire. Because what most people mistake for economic strength today is actually debt-fueled expansion, asset inflation, and the power of the dollar rather than real productivity or broad-based prosperity. And this distinction is critical too. Understanding why many economists argue that the end of empire does not arrive with a dramatic crash, but with a quiet erosion of trust, stability, and living standards, especially for the middle class, which historically has been the backbone of American economic power. After World War II, the United States emerged as the uncontested global hegemon, controlling manufacturing, trade routes, financial systems, and the world's reserve currency. And for decades, this position allowed America to run trade deficits, finance wars, and consume more than it produced without immediate consequences. But empires that rely on privilege rather than fundamentals eventually face the reality that financial dominance cannot indefinitely replace industrial strength. Over time, the U.S. economy shifted away from manufacturing and productive investment toward financialization, where profits increasingly came from speculation, debt, and asset appreciation rather than innovation or wage growth. And while this benefited Wall Street and corporate elites, it hollowed out the economic foundation for millions of workers, leading to stagnant wages, rising inequality, and a growing dependence on credit to maintain living standards. The 2008 financial crisis should have been a moment of reckoning, a clear signal that the system was unsustainable. Yet instead of reforming the core structure, policymakers chose to stabilize markets through massive bailouts and monetary stimulus, effectively teaching financial institutions that risk would be socialized while profits remained private. And this moral hazard accelerated the very behaviors that caused the crisis in the first place. Quantitative easing, near zero interest rates, unprecedented liquidity injections propped up stock markets and real estate prices, creating the appearance of recovery, but this recovery was uneven, fragile, and increasingly detached from the real economy. As productivity growth slowed, labor participation declined, and household debt climbed to record levels. For the average American, economic success became less about working harder and more about owning assets, which disproportionately benefited those who already had wealth. While younger generations faced higher education costs, unaffordable housing, and limited upward mobility, a pattern historically associated with late-stage empires where opportunity narrows and social tension rises. The dominance of the U.S. dollar, often cited as proof of American economic strength, is itself a double-edged sword, because while it allows the U.S. to borrow cheaply and run chronic deficits, it also incentivizes overconsumption, discourages domestic manufacturing, and exposes the economy to systemic risk if global confidence in the dollar ever weakens. In recent years, geopolitical shifts, rising multipolar competition, and efforts by other nations to reduce dependence on the dollar have highlighted a growing vulnerability in a system that once seemed unassailable. And although the dollar remains dominant, its long-term supremacy is no longer unquestioned. especially as debt-to-GDP ratios reach levels historically associated with decline rather than growth. The U.S. government's fiscal trajectory reflects this deeper issue, as deficits are no longer driven by temporary crises alone, but have become structural, fueled by entitlement obligations, military spending, and interest payments that consume an increasing share of the federal budget, leaving less room for productive investment in infrastructure, education, and innovation. This creates a feedback loop where declining public investment weakens economic competitiveness, which then requires more borrowing to sustain growth, pushing the system further into dependency on debt. At the same time, political polarization and institutional gridlock make meaningful reform increasingly difficult. As short-term electoral incentives override long-term economic planning, a hallmark of declining empires that struggle to adapt to new realities. From a global perspective, history shows that no empire collapses solely because of external threats. They collapse when internal contradictions become unmanageable, and in the case of the United States, these contradictions include extreme inequality, declining social cohesion, and an economic model that prioritizes financial markets over human capital. While technology and innovation continue to produce extraordinary advancements, they coexist with widespread economic insecurity, suggesting that progress is no longer translating into shared prosperity, which undermines the social contract that once legitimized American leadership at home and abroad. For audiences in the US and UK, this story resonates because it challenges the comforting narrative that economic dominance is permanent, reminding us that Britain once believed the same during its imperial peak, only to discover that debt, overextension, and structural imbalance quietly reshaped its global role. The question, then, is not whether the U.S. economy will collapse overnight, but whether it can fundamentally reform before the slow decay of its economic foundations transforms global leadership into historical memory, and whether the next chapter of American power will be defined by renewal or by the familiar pattern of empires that mistook financial strength for economic health until the gap between the two became impossible to ignore mistakes. Check important. As the foundations of the American economy weakened internally, the global environment that once protected and amplified U.S. power also began to change, exposing how dependent the system had become on assumptions that no longer hold true. Because empires do not decline in isolation, but in relation to a world that evolves, adapts, and eventually challenges the rules set by the dominant power. For decades, globalization worked overwhelmingly in America's favor, allowing corporations to outsource production, lower costs, and boost profits, while consumers enjoyed cheaper goods. But this model quietly transferred industrial capacity, technical expertise, and long-term growth potential to other regions, particularly Asia, creating competitors that no longer needed the U.S. market or financial system as much as they once did. China's rise is often framed as the primary threat to American economic dominance. Yet the deeper issue is not competition itself, but the fact that the U.S. economy is structurally less prepared to compete, having prioritized consumption and financial returns over resilience, supply chain, security, and domestic production. Disruptions reveal this fragility in stark terms, as shortages of basic goods, medical supplies, and critical components showed that efficiency. Driven globalization had come at the cost of national economic security, forcing policymakers to confront realities that had been ignored for years. However, rebuilding industrial capacity is far more difficult than dismantling it, especially in a system where short-term shareholder value dominates decision-making and where labor costs, infrastructure decay, and skills gaps make reshoring expensive and politically complex. At the same time, rising interest rates marked the end of an era that had sustained the illusion of stability, because cheap money had been the glue holding together inflated asset prices, government deficits, and corporate debt. And once that glue weakened, cracks began to appear across markets that had grown dependent on perpetual liquidity. Higher borrowing costs not only strained households and businesses, but also exposed how little real growth had been achieved beneath years of monetary stimulus. As zombie companies struggled to survive, housing affordability collapsed, and governments faced escalating debt servicing costs that crowded out future spending. For the first time in a generation, financial markets were forced to reckon with risk again, and this shift revealed how deeply interconnected the global system had become. Where stress in U.S. bond markets could ripple instantly through currencies, banks, and economies worldwide, amplifying the consequences of American policy decisions. Meanwhile, the geopolitical use of the dollar as a tool of sanctions and leverage, while effective in the short term, accelerated efforts by other nations to build alternative payment systems, trade agreements, and reserve strategies, not necessarily to overthrow the dollar overnight, but to reduce vulnerability to a system increasingly perceived as politicized. History suggests that reserve currencies lose dominance gradually, through diversification rather than collapse, and even a slow erosion of dollar centrality would significantly raise borrowing costs for the U.S., limit fiscal flexibility, and reduce the ability to project power without consequence. In the UK, this dynamic is particularly familiar, as Britain's post-war experience showed how loss of reserve currency status forced painful economic adjustments and redefined its global role. A parallel that many analysts now draw when examining America's long-term trajectory. Domestically, social pressure continued to build as economic stress translated into political volatility, with populism on both the left and right reflecting a shared frustration with systems perceived as rigged, unresponsive, and disconnected from everyday reality. Trust in institutions declined as people struggled to reconcile rising stock indices with declining affordability, questioning an economic narrative that celebrated growth while ignoring distribution, stability, and dignity. This erosion of trust matters because economic power ultimately depends on legitimacy, both at home and abroad. And when citizens lose faith in the fairness of the system, sustaining long-term policy discipline becomes nearly impossible. The result is a cycle where governments respond to dissatisfaction with short-term relief rather than structural reform, deepening deficits and postponing difficult choices, which further weakens confidence and accelerates decline. What emerges is not a sudden fall, but a prolonged period of adjustment marked by volatility, slower growth, and contested leadership. Where the United States remains powerful, yet increasingly constrained, influential, yet no longer unquestioned. In this phase, the end of empire is less about losing everything and more about losing the ability to shape outcomes effortlessly. As economic gravity slowly shifts toward a more fragmented, multipolar world where dominance must be earned through competitiveness rather than assumed through history, to prefer this response. The final question is not whether the American empire is facing decline, but what kind of transition lies ahead. Because history shows that when economic dominance fades, nations either adapt through reform and reinvention or resist change until external pressure forces a harsher adjustment. And the path the United States chooses will define not only its own future, but the structure of the global economy for decades. One of the most dangerous assumptions in modern American discourse is that innovation alone will solve structural economic problems. Yet technology, while powerful, cannot compensate for an economy where the benefits of growth are increasingly concentrated, public institutions are weakened, and long-term investment is sacrificed for short-term market performance. True renewal requires political and social alignment around difficult choices, including rebalancing consumption and production, reducing dependence on debt-driven growth, and restoring faith in institutions that manage economic power. But these reforms are challenging precisely because they threaten entrenched interests that benefit from the current system. For empires in decline, the greatest risk often comes from within, as polarization, identity politics, and zero-sum thinking replace shared national purpose, making consensus-based reform nearly impossible. And the United States increasingly exhibits these symptoms. Where economic anxiety fuels cultural division, and economic policy becomes reactive rather than strategic. The global consequences of this internal struggle are already visible as allies question long-term reliability. Competitors accelerate efforts to build alternative systems, and neutral nations hedge their exposure to American financial influence, not out of hostility, but out of rational self-interest in a more uncertain world. This does not mean the United States is destined for collapse, but it does mean that its margin for error is shrinking. Because sustaining leadership in a multipolar world requires credibility, stability, and economic vitality rather than sheer financial scale. The comparison to Britain's imperial decline is again instructive, not as a warning of irrelevance, but as a lesson in adjustment, because the UK's long-term stability came not from maintaining dominance at all costs, but from redefining its role, strengthening institutions, and integrating into a new global order. A process that was painful but ultimately stabilizing. For the U.S., similar transition would involve accepting that economic leadership in the 21st century may look different from the post-war era. With less unilateral control and more cooperation, less consumption-driven growth, and more investment in resilience, education, and infrastructure. The challenge is that such a shift demands patience and sacrifice. Qualities that are difficult to sustain in a media and political environment driven by immediacy and outrage. Where complex economic realities are reduced to slogans and blame rather than addressed through long-term planning. As a result, there is a real risk that reform will only occur after a crisis forces it, whether through a loss of market confidence, a fiscal shock, or a geopolitical event that exposes the limits of financial power. And history suggests that reforms made under pressure are often more disruptive and less equitable than those undertaken proactively. For ordinary citizens in the US and UK, the implications of this transition are deeply personal, because the end of empire is not experienced in abstract charts or policy debates, but in job security, housing affordability, access to opportunity, and the sense of whether effort leads to stability or constant struggle. This is why the narrative of decline resonates so strongly today. Not because people believe the country is failing in absolute terms, but because they feel the system no longer works for them as it once did, creating a disconnect between official economic indicators and lived reality. Ultimately, the future of the U.S. economy will depend on whether it can move beyond the illusion of perpetual dominance and confront the structural weaknesses that have been accumulating for decades, recognizing that empires do not end because they lose power, but because they fail to adapt to the responsibilities that power creates. If the United States can reform its economic model, rebuild trust, and align innovation with shared prosperity, it may not preserve empire in the historical sense, but it can secure relevance and stability in a changing world. If it cannot, then the end of empire will not arrive as a dramatic collapse, but as a slow normalization of decline, where reduced influence, lower expectations, and constrained choices quietly redefine what was once unquestioned global leadership.